Good morning, everyone, and welcome to the Deal Structuring to Maximize Access to Capital panel. My name is Sean Kraus. I'm a registered principal at North Capital Private Securities. With me today, I have Grant Nelson, my colleague, Director of Originations. Grant basically performs due diligence and helps onboard offerings onto our platform. Also, I have Leslie Jump here with me. Leslie has over 25 years' experience in building, advising, investing in new companies, products, and brands. Prior to different funds, Leslie was actually with Sawari Ventures, a Cairo-based venture capital firm specializing in investments in North Africa and throughout the Middle East. Different funds, Leslie's current incantation is the first platform designed and built for investing in venture funds. Basically, their network spans 65 markets in the United States and overseas, and they source from over 800 different funds. To my right, I have Lou Feldman. Lou was an attorney for over 35 years, has helped raise money and place capital over $100 billion in the housing, infrastructure, and technology sectors. Lou's been part of several successful launches, including some well-known names like Patch of Land, CrowdStreet, Fundrise, as well as Realty Mogul. Lou is currently president of KBS Direct, a subsidiary of KBS, which is one of the largest, most successful real estate companies in the United States. In fact, actually, KBS, according to National Real Estate Investor, is the 8th largest owner of office properties globally. And currently, KBS, as of June 30th of this year, KBS has about $11.5 billion under management. And then at the very end, we have Marty Tate. And Marty actually is a late addition to the panel. So Marty, I'll let you introduce yourself.
Oh, great. Yeah, Marty Tate. I am a securities lawyer. I've been practicing about 20 years and have been very active from the beginning in the crowdfunding space and worked with a number of well-known platforms and crowdfunding portals, and over the last probably 18 months have seen a lot more activity in the sort of token digitized security and security and token space. And yeah, I'm with the firm Carmen Lenhoff Israelson, which is a securities boutique based here in Salt Lake City.
Great, thank you. And Marty, we might start with you. What trends are you seeing? Now, you kind of touched on it a little bit with the tokenization, but what trends are you seeing as far as new issuers?
So I think that I was just speaking to someone earlier that, we saw there was definitely a flurry of activity over the last 18 months in the ICO or the crypto space, and I was receiving 3 to 4 calls a day of people wanting to do ICOs. Most of that time was spent trying to talk them out of it. And what I'm seeing now is you're seeing just a maturity of that market. You're seeing issuers, if in that space, you're seeing more issuers, you're seeing more mature issuers that are actually have real businesses, real business ideas. You're seeing actual, again, it's the people that kind of sat on the sidelines and are now saying, okay, we're ready to enter that market, which is good. There's more legitimacy to it. And I think you're seeing, again, just a continual evolution of the security space. I think that it's continually going more and more online, more digital, and I think that sort of blockchain, distributed ledger technology, I think will help accelerate that. And it's just a matter of getting regulations in line with that.
Is that the biggest impediment right now, is the regulations?
I think it's regulations and technology. I think both those things you have to take systems that have been in place, for a number of years. And there are companies, there's groups here in the audience that are doing those things, taking stock ledgers and putting those on the blockchain, allowing even North Capital, you guys have, introduced you guys have the ability to custody digital assets. I think all those things that's the technology that's catching up with it. The regulations, I think the SEC has said, these are the rules, abide by them. But you are, I think you're seeing, it, on one hand, you're seeing a lot of bad actors that are being, slapped in the wrist and said by the SEC. But you're also, I think, you're seeing the people that are trying to comply with regulations. They're not being necessarily hindered, and I think the SEC is willing to work with them. So hopefully there'll be. I don't know if there'll be a change in regulations, but I think that there'll be maybe a evolution of how those regulations are applied.
Yeah, okay. You think the kind of the Wild West days of the ICOs are kind of behind us?
I hope so.
Yeah.
Like I said, there was just a period where people were seeing, millions and billions of dollars being raised, without giving away anything.
Right.
And that's what all these companies wanted to do. Issuers were calling saying, well, hey, we want to do an ICO because we don't need to sell equity or debt or anything. We can just sell nothing. And I hope those days are over.
Yeah. Grant, are you still seeing a lot of interest in ICOs? Are you also seeing that kind of wane a little bit?
It is definitely waning, and it's kind of exactly what Marty said. In the early days, we were getting calls all the time by people who wanted to do things through a securities token offering, but they didn't want to give up much. They just wanted to issue their tokens, and we, like Marty, would spend most of our time trying to talk them out of it. And now what we see is these companies that are focused on the on blockchain, and they're doing a more traditional offering, a 506B, 506C, kind of convertible note offering there.
Right.
So yeah, that's kind of what we're seeing right now.
Okay. It's good to know. And Lou, I wanted to ask you, because KBS is kind of a unique situation, very successful in fundraising, but you guys started raising money through publicly registered offerings, not publicly registered non-traded REITs. You've done a lot of private placements and a lot of institutional money raises, but now you're going back to the public markets with the Reg A Plus offering. Why did you guys choose Reg A Plus?
Well, we actually started with 506C, and the idea that Peter Bren had, Peter's 84 years old, and I'm the chairman of the real estate school at UCLA, the Ziman Center, and Peter's on my board.
Okay.
So in 2004, there was a big change in capital raising for REITs. There were the broker-dealers were going out and shoving a bunch of investments in people's IRAs, not telling them what their fees were, but saying you could earn 6%,
Right.
and coming out with 86 cents on the dollar, and taking a few years to earn your money back, even with great assets. That dried up in 2014, 2015, went to a $20 billion business, came down to about a $4.5 billion business because the fiduciary standard was in flux, the Department of Labor rule came in, and there was basically nobody was selling non-traded REITs. And so Peter said, we have to do something different. We have to do something, we have to harness technology. We had a conference at UCLA in 2014 that CrowdStreet was there, real Fundrise, everybody who was a player at that time, his eyes lit up and he said, we're going to go direct. And we're not just going to go direct, we're going to continue to play in all the different spaces, which makes it difficult because broker-dealers don't like what we're doing on the direct side. And we haven't touched ICOs yet, which I want to definitely look at, because in Oakland, they just did a tokenization of a $10 million office building that worked, and that was just announced, I think, either Friday or Monday. And so it's working. It's starting to happen. And again, we learned back in the insurance days when insurance companies couldn't make arbitrage in the stock market. What they did is start cutting costs, and they started going directly. And by cutting costs, they were able to then create greater value for their shareholders. Same thing here. By cutting costs, we're able to get more money into the ground and at work for the investor. And that's all we're looking for, is the ability to just eliminate unnecessary expenses. We have had such a great partner, and I don't mean to make this sound like a commercial, but it's truly sincere. North Capital's been unbelievable for us in helping us understand the landscape and being able to transition from a company that's done $25 billion, $25.6 billion in the public markets, to someone now who has a $1 billion fund. We have about $100 million that we've raised both through private placement and directly, and we're launching that. But our deal is no upfront costs, no commissions, and just like any other partnership, a split with the sponsor, the investor gets 85 cents over a 6% return on every dollar, and we get 15 cents. And other than that, we get a point a year. It's very, very different than the days where it was 7% to this group, for a broker-dealer, 3.5% to lead the broker-dealer group, and then all the other expenses. And so for us, Reg A became a way to reach the unaccredited investor. And we're a little different. We have a master REIT, and then we have little Reg A's that are beneath it. We borrowed that from the Regulation CF. A lot of people were doing that with the $15 million approach using a Reg A, using Reg CF. And we just did the same thing with mini REITs. So you can either buy an overall piece of our office buildings, and we have, they're all 96 to 99% occupied. They're seasoned, they're in high growth markets. Or you can buy in a specific region based on the smaller REIT itself as an individual investor, not having to be accredited. So if you want to be in the big thing, you got to be accredited right now. And then we have little $50 million deals where you can go in as unaccredited. But the idea is to hit everybody, IRAs, RIAs, BFDs, VIPs, whatever. But
CIA.
Yeah, exactly. But be able to be full spectrum in terms of the investors and bring capital in and help people who should get institutional returns, get the institutional returns on something which is on a risk-adjusted basis, is a very safe approach.
Right.
So if you're supposed to have 40% of your assets in alternatives, which is what large institutions do, we want to be part of that 40%. We want to be the solid portion of that 40%, certainly. And then you can throw in the other, some other pieces of it. But that's been our approach.
Yeah, sounds great. Grant, are you also seeing a lot of Reg A plus interest?
It's definitely been growing. It's
Yeah.
not a large part of our business right now, but we have traditionally had maybe one or two Reg A Plus offerings looking to get qualified by the SEC, and right now we have 5 that are currently in process, and those are all real estate companies as well, which is where we've seen success in raising capital. We've done a couple Reg A Plus offerings, tier 2 for earlier stage companies, and they just haven't worked out, haven't gained traction. But in real estate is where we've definitely seen it. It's growing. It's just still not a large portion of our business.
Yeah, perfect sense. Hey, Marty, you work with Reg A Plus a lot as well?
And like Grant said, I think that where I've done over, somewhere over a dozen Reg A Plus, and I think we've seen more success in the real estate side than we have in the operating company side, even though I think that it still is a good option for a company that what I would say is if you have a strong network or a track record. Where we've seen success is like a company that has that's gone direct is a company that has a product that they have lots of customers. They have they're very active on social media. They have a good presence there, and they're able to tap that network. And we've seen some success there. Where companies struggle is where they don't have that presence. They're coming out of the gates and they're trying to say, here we are, and unless they have something that's just really novel, some sort of widget that's fancy and shiny and that people can grab onto. But and in the Reg A Plus space, we've actually, as we talked about, tokenized securities, we're seeing, I think we've got 4 of those offerings now that we're working on. A couple of them we filed with the SEC. We're in that process. It'll be interesting to see how those are accepted. But 2 of them are in the real estate space, and I think that will be once these start going through. I think that we'll see that you'll see a wave of offerings that are digitized, this sort of digitized securities under Reg A Plus. I really think that's the way to do a token offering is through Reg A Plus. You can raise up to $50 million. Your limits, you can go to non-accredited investors. it's the securities are unrestricted. Now, that going back to what I was saying before, that's where the technology has to catch up. There are several exchanges that are currently at various stages of approval with the SEC, but I think the hope is that within the next 6 to 12 months that there'll be a number of security exchanges where these tokens, digital securities will be able to be traded, and that will create this liquidity that we haven't had before. That's what everybody is envisioning.
Right,
And
right.
and I think that's where things are hopefully moving. And if they do, I think like was said before, I think that securities offerings, I think that's where they'll go. I think you'll see office buildings they're selling, a tokenized security.
Right.
Under Reg A plus or under a 506C. And I think that will be the future of this.
The difficulty that we have with Reg A in real estate is that $50 million limitation
Right, right.
itself.
Yep.
Our average building is 50% leveraged, and the cost of the building is somewhere around $45 million. We typically hold a building for about 4 years. But if you can get maybe 2 buildings out of that.
Right.
And so to leverage that, you need to continue to do more and more Reg A's. And then the other aspect of it that is not as good as 506C is it's like catching fish. It's you set up a net, you tell everybody about it during testing the waters. The problem that we have with that is if you're running like we do, a public offering, we're in Singapore or the United States or wherever we may be, once that's running, then your Reg A, your testing the waters becomes more difficult. Your regulatory, what you can and can't say becomes more difficult. So the timing of everything is really tough. The tokenization will help speed up, you would think, a close, but this idea of catching everybody at the end of the day as opposed to being able to have a continuous open offering is one of the more difficult things to manage.
Yeah, and if I could just push back on all that for a minute. I mean, looking at it from the private equity perspective, there is so much capital available in the private markets right now. Talented entrepreneurs are hard pressed to put up with all the nonsense that are required for either a 506C offering or a Reg A. And so what we're seeing is this dichotomy. I think you mentioned it a minute ago. Companies have a particular product, a widget that consumers can get into, or I'm on the board of a company that's a media company that was able to successfully crowdfund earlier. Other than that, they're saying, why bother?
Right.
Too much of a headache, messy cap table, I'm out.
Right, right. And that's why deal structure is a little different for you, being in venture capital. You guys are pretty much focused on 506B, because that really
100%.
works. Yeah. There are very few venture capital funds that are 506C even.
Right,
correct?
yeah, and I don't think they've gone that well.
Yeah, right, right. So I guess deal structure is not that important to you, but what are you seeing additional trends or new trends coming out in venture capital funds? And what would those be?
Yeah, I mean, one of the reasons we call ourselves different is because the different funds that we work with are so highly varied. I mean,
Right.
our funds, right now, we're working with about a little bit less than 100 funds. They're raising about $3 billion. They're in 30 different markets across the country. They're not concentrated in the Bay Area like everybody thinks when you talk about venture, or even New York. They're really distributed. They're in 20 different sectors. And one of the things that we're really excited about is we are seeing some experimentation now with things like revenue-based funds.
Right.
Revenue, who knew? What a way to fund a business, right?
Right.
And so those funds are funds that are actually paying dividends to their equity holders. We're seeing some evergreen funds, where people are buying into the actual operating company itself, and it's distributing capital.
Right, right.
And I think that we're going to start to see more experimentation of that type, because the reality is that and you may be experiencing this a little bit with the Reg A's, the lockup period for private equity is long for most investors. It was really designed for institutions that have a perpetual landscape to look at, right? So when you're talking about people, that's a long time. And yeah, it can be high reward, but statistically the odds are it's modest reward. So to the extent that we can start to see some modifications in the structure of the classic 220 10-year fund, I think that'll accelerate more capital through the markets for everybody.
Right, right. Interesting. And you mentioned something that was really intriguing to me in terms of opportunity zones. And this is something I had not actually heard of until you brought it up, but can you explain
Yeah,
that?
no, and the real estate guys here may know
Yeah.
a lot more about this than I do. If you remember the 1031 exchanges, so basically tucked into the tax bill last December was this thing called opportunity zones. And all of the states designated opportunity zones, had an opportunity to do it. And now the deal is that you can take capital gains from another investment. So let's say you want to sell $1 million in stocks to invest in, one of your buildings, right? And that building happens to be in an opportunity zone. You defer the capital gains on that original investment for the period of your investment, and then you permanently defer the capital gains on that investment. So it's a sweet, sweet deal. Now, they've tried to structure it in such a way that it can be applied to both real estate and venture. A little bit more questionable about how it's going to work with venture because of venture timelines.
Right.
And as I understand it, Treasury's got the legislation right now and is working through the final rules. But there are people who are really excited about it. We're going to put up some information about this on our platform. We are aware of some funds that have started to launch. The big joke is that every VC in Sand Hill Road is going to move all their companies to Oakland because that's an opportunity zone.
Right.
But so it has enormous potential, but there are still a lot of questions.
Yeah, definitely, I can imagine.
There are 40,000 opportunity zones that have been designated in the United States. And it is interesting that you can invest in pretty much any asset, including businesses in those areas. A couple of questions come up because we don't have mature regs, as you pointed out. The deferral is through 2026, I understand.
Right.
And
For the original capital.
for the original capital
Right.
is 2026. And so having people roll that and protect that, that's one of the big questions, because it's not like doing a 1031 where it's a permanent until you then flip it again. And then the other thing is just the award and how it's going to be administered.
Yeah.
And there are areas, I know that Griffin Capital, for example, Kevin Shields has put together a fund but can't call any money because they can't, you have to identify and deploy very quickly, very similar to a 1031. So the timing is interesting, but ultimately if you hold that property for 10 years, your gains are yours. You don't have to pay taxes on them.
Right.
And that is a game changer for a lot of people.
Yep.
Just as 1031s have been, because the cost of capital goes way down when people don't care about what they earn, they just don't want to pay taxes.
Right. Yeah, it's a huge performance bonus.
Oh, yeah,
Whatever the
huge. Absolutely.
investment is.
Absolutely. Now, do you expect the 1031s will dry up because of this, or do you think there's still a market for those?
I think there's a market for both. There are just too many 1031s out there for there not to be a market. But I think QOZs have qualified opportunity zones have just a much more. You can do it in business, and you can't do that with a 1031.
Right.
And that's the biggest difference. So I can put money with Magic Johnson, and he can go into an area and do whatever he wants, and then I never have to pay taxes on the amount of money that I make with Magic.
Right.
That's magic.
Well, and like you said, yeah, if you can make the timing work out for venture capital,
Right.
that would be great. If you have a home run, that would be fantastic.
Right, yeah. I mean, the folks that we're seeing making the first movement into this tend to come from impact investing.
Yes.
And there's a lot of conversations about, impact, is it philanthropy, is it investing? I think this will help edge it to the latter. I mean, if you get the immediate tax benefit and the perpetual tax benefit, I
Right.
think that makes a
Right.
huge difference for these folks.
Yeah, absolutely. Marty, are you seeing a lot of these opportunity zone funds, or are you starting to see those investments?
So it's interesting that twice we've mentioned Oakland. I have a client in Oakland
Yeah.
that's they're also heavily in the cannabis space,
I
which
was
is
going to say,
which is
it's like Pot Central.
yeah,
Yeah.
I think they had some other term for it, but yeah, Pot Central works. One of the things that I actually wanted to elaborate on is with these funds. I agree that I think you're seeing different structures than the 2 and 20 and 10 years. But the other thing that you've seen over the last several years is that evolution of these funds and their capital raising, even under 506B, towards taking it online. I have a number of clients that have, they've been syndicators, or they've managed venture funds, and they've just their traditional model has just been they go out, they talk to people, they send out subscription documents, and what I'm seeing is a lot of those people have taken that same process and just put it online, so that now they're able to go out, and it's just, again, an evolution of the process, and it really facilitates the and makes that whole process of raising capital a lot easier. So.
Yeah, well, I mean, the dirty secret about venture capital is it hasn't innovated since the Eisenhower era. You know, I mean, it's, you know, here we are supposed to be these big investors in innovation, and, you know, accounting, QuickBooks was a big, you know, moment for us. But you know, you're absolutely right. People are, and the reason is because venture has a math problem. If you go back to the fact that venture was kind of like, they said, okay, let's take private equity and make it smaller. Well, yeah, kind of, sort of works, sort of doesn't. And so, you know, people think about these massive funds that we hear about, you know, the SoftBank fund, Sequoia Capital raising $8 billion. The reality is that in this country this year, the median size of a venture capital fund raised is $60 million. Well, there's two important facts that go along with that. Most institutions won't look at you if you're under 100 million. How many people can ring up enough, you know, high net worths to raise $60 million? So they are looking for more tools to be able to add to the toolkit to expand their capital.
Makes perfect sense. I think we have time for one final question for everybody here. What advice would you give to an issuer that's just starting to raise capital? Grant?
I would say do your due diligence. I've seen a number of issuers, they get caught, they're trying to close on investors, and oh wait, we can't close on this specific investor because he doesn't meet net income requirements or something else. So really dig in, do your due diligence. I mean, as an issuer, you're going to know your potential investor base better than anyone, and really pick an offering exemption that's going to fit for your capital raising plan.
Makes sense. Leslie?
Similar, I would say do your homework. Fundraising is really another word for marketing.
Right.
And so you need to think about it as a campaign strategy. You know, who are your most likely prospects? How are you going to reach them? How are you going to engage them? What have you got that they're interested in? So I think that's the key point to start with.
Okay, perfect. Lou?
Yeah, I think marketing is important. I think understanding inbound marketing and outbound marketing. I think the first thing I would do is actually surround myself with people who are a lot smarter. My grandfather always told me, always be around people who are smarter than you. So if you die, other people think you were smarter than you were. And so I follow that. And so, you know, the North Capitals of the world with people who've grown up and been grinding out this business, like, you know, your legal expertise and what you're all doing, that's incredibly valuable. That just moves you right up. And one of the resistances people have is spending money on advisors or getting involved. But you can learn a lot, and loyalty and relationships are really important, and build those relationships early on. Don't burn bridges as you move forward, because it's a very small community at this point. That would be the other thing I would say.
Yeah, and you had mentioned at one point previously as well, you recommend a 506c structure for people who are issuers who are starting, just to get that exposure?
Yeah, I think that from a marketing perspective, you know, real estate has been an analog business for so many years, and we've been limited when you do a public offering to just have a tombstone, and that's been it. So nobody really knows KBS, even though we're the 6th largest or 8th largest office building owner in the world. People don't hear your name as much as they would someone like a Blackstone or whomever, who get out there with a lot of advertisements and have CIM and others. So for us, having our own website and having being on marketplaces could only occur through a 506c, where people can be active and come in. So if you go with a Reg A, again, limitations on what you can say after you close the gate. But with a 506c, it is a way to get your message out there. And you have to be careful if you're running simultaneous offerings to stay in your lane.
Yeah.
But it's a game changer in terms of bringing people's visibility into the mind share of the investor.
Yeah, and it's definitely worked with KBS. No
It's
question.
working. Yeah, it is.
And Marty, what advice do you have for new issuers?
So, yeah, I would agree with everything that's been said. When we get calls about people say, hey, we want to do a capital raise, the questions I ask are, who do you want to raise it from? What do you want to sell? And how do you want to sell it? Because, you know, we'll get calls and people say, hey, I don't know whether to do a 506C or a Reg A, and they don't really even know what they're talking about. They just have heard these regulations, but they don't quite understand what that means or how to approach it. And so we'll try to back up and say, okay, well, are you going to sell equity or debt? Let's answer that. Who are you going to sell it to? Do you have a couple of private investors or a good network that you can sell to? If so, then let's concentrate on that. If not, then if you want to try to crowdfund, okay, well, then let's look at how do you want to do that? Do you think we could go after accredited investors, or do we want to try to open it up more? How much do you want to raise? That becomes important. A lot of times, obviously for a Reg A plus, they're expensive. And somebody might say, well, I want to do Reg A plus, and you end up talking them into doing just a much smaller, offering that might even qualify under a smaller state exemption. So there's a lot of different options. I think that I would reiterate, talk to an advisor, talk to people that have been through the process and understand. And then it really, raising money is marketing, and it's. I think that even with the Reg A plus, people will come to us and say, well, we want to do this, and we've got this much budgeted. And I'll always say, well, how much do you have budgeted for marketing? Whatever that is, double it, because that's how you're going to promote it. So that's what I would suggest.
Yeah. And in terms of people that come to you for advice, do they generally tend to be novice issuers, or are they kind of a mix, novice and well-rounded, well-experienced?
It kind of depends on the referral source. I think we get we get a lot of people that are novice and that are trying to, it's funny, you go to conferences and you hand out cards, and it seems like most of those people are novices, but, generally if I get a referral from North Capital, I know that it's somebody that's done it before, so that's always very helpful. So.
Okay. Well, thank you. Well, I think our time is up now, so I want to thank everyone on the panel. Grant, Leslie, Lou, Marty, I appreciate your time. Appreciate